Welcome to stockexposure.com. My name is Sajid Mukherjee and I'm Chief Strategist of Equities. We're going to discuss in this video today what's the right market context, when is the best time to find entries, and hopefully you'll take away a pretty decent guide from this video. The standard disclaimer applies. Investing decisions are all subject to market risks. Please do your own research before investing. And since we're an educational initiative, neither do we require SEBI registration, and all our trades here are for illustrative purposes only. The very foundation of what we're discussing today is that one steps on the gas only when the road ahead is clear. If you're going to look at the idea of finding the right market context, you need to ensure that things all align in place. If the market context is weak, it's not a good time to buy stocks. If the market context is good, that's the time you should be moving from cash to different names. So this is an excerpt from our website of what we define as market context. You'd of course want to look at stocks which have strong fundamentals, but after you've determined that, you need to figure out if some basics adhere. The price should be above the 200 DMA. That's point number one. And the 200 DMA should be pretty flat, if not sloping upwards. The 20-day moving average should be above the 200 DMA. Some people also say the 50 DMA should be above the 200 DMA, but logically then below the 20 DMA. This would pretty much be the ideal state of the moving averages. Once you determine that, you want to see a price surge in the preceding few months in that particular name. How? So anything between say 30% to about 100% in say a couple of months or say about a few weeks, you'd find a price surge like this going up. This becomes a good market context. This is a good market context. When you see charts like this, the price is moved up like this, the moving averages are aligned. This is the time you can look to buy stocks. And the fourth point, I'd also like to mention, I can probably throw a bit more light on that with some examples. The left-hand side of this chart needs to be reasonably clear. What I mean by that is that there must be a price void. A price void is an area on the chart wherein you don't have price bars having very, very obvious resistances. So for example, if the price structure on the left-hand side of the chart was this, and suddenly you're going up, so you've got resistance here, you've got resistance here. This is not the best. This is probably an 8 out of 10 setup. But if at all, in the same chart, you probably had price going directly up, say from here, and just moved up as well. This entire area here is clear. There is no data on the left-hand side. So you know that this is a price void. And because it's clear, the price is free to move ahead. It doesn't have prior price data to act as any form of a resistance. So then, once you determine these, 1, 2, and 3 can be determined objectively. And of course, point 4 is a bit of a discretionary effort. You know that names, you're almost certainly going to be into those names that are most likely to double ahead of you. So now, if I had to put it in that sense, this is what would be the picture of power as we've discussed. The 20 DMA, the 50 DMA, and the 200 DMA aligning, price structure going up, finding support in any one of these moving averages, and then moving up. These areas are called price voids. Again, no data here, no data here. So if you're looking at price at this point of time in a chart, you know that you only have this resistance to deal with. If you're looking at price here, you only know that there are these 2 points. Once you've cleared, you can have any form of an entry here. So when you enter with a stop perhaps here, or more conservative traders might look to have a stop here. Let's take an example of a stock called Birla Soft. I'll take you to 2023. What we're seeing here on this chart is the complete opposite of what the picture of power looks like. We're actually seeing a picture of weakness. The 200 DMA in red is sloping down, the 50 DMA in blue sloping down, 20 DMA in yellow sloping down, and the 8 DMA, this black line is the 8 DMA, all down. And price is actually, price bars are below all of these four. So it's the complete reverse. So you know that, say, it's 2022 till, say, the first half of 2023 till about, say, May. This is actually a picture of weakness. You're not supposed to be looking to time any form of entries here. But then you get a price surge. You get a solid price surge of, say, from 250 to 350. This is about a good 35 to 40 odd percent. Once you've got a price surge, you see how the averages align: 8, 20, 50, and the 200. And you have the price above all of these. Any correction, any sort of a basing pattern here suddenly becomes a good buyable opportunity. Why is that? Because got one resistance here, got one resistance here, got one resistance here, but then this entire area is a price void. What happens next on the chart is that from that moment onwards, say May 2023, where you found this one particular base, this would have been an ideal entry. This is a good rounding bottom and this a bit of a handle. You see an entire surge up. See one leg up. So this was leg one. This was leg one. This was a base, leg two. Falls in, forms another little handle, entry here, or alternate entry right here. Another surge up, another base, and so on and so forth. Now, how this happened is because there was a significant resistance here, but these minor resistances here didn't have much of an effect. You have a massive price void. That's what I was talking about. The market context all throughout here in this chart is weak. This entire area, the market context is weak because the averages don't line up at all. But here, the averages line up. It is at this particular point you see a surge in price and the averages start lining up. The point at which averages line up and the price straightens out, you know that buy opportunities are more likely to prevail, and when they do prevail, they're going to give you a large move. If you think this is actually a cherry-picked example, Birla Soft in 2020 actually had a very similar scenario. This was 2023 that we were talking about. I'll go to the next particular slide and give you the example of how it looked like in 2020 as well. Here we go then. You see how, say, October, the second half of 2019 to the start of 2020, let's say during the COVID crash at the end of March, context is weak. The averages don't line up and prices trending downwards. In fact, at the start of 2020, it actually improved, and we actually just did see a little bit of a surge, but again, wasn't that good. And we actually had significant resistances here. So we didn't really get much of a base. So we had one bit of a failure and we had another dip down. And then, of course, the market started recovering. Now, even when the market did recover, not until July did we cross this particular high. So if I had to look at the entire picture, there was a pretty solid resistance that Birlasoft had to take out, say around about say July 2020. Up until then, these averages are not really uptrending because this is a range. So even if averages start lining up like this, unless you've actually broken this resistance, this horizontal line, you're not going to be saying that you're in an uptrend. But once it did take it out, and we had a phenomenal recovery that particular year. We actually made one heck of a move up. You can actually see here, if we took this out, we only had this resistance to deal with horizontally. So this was a bit of a buy. I'm not saying this is not the best buy though. But then when we did take out this prior high, say at what the 175 odd levels, we had a very good rounding base pattern here. And the averages tightened up. We had a bit of a narrow state. So we had one heck of a surge, a nice rounding bottom, another leg up, another rounding bottom, another leg up, so on and so forth. So the market context, even though the averages aligned at this point of time, it was still not the best. Here, of course, it had failed. So this failed. This is neutral. This isn't the best moment. This has its limitations because you have a significant resistance impending. But once this resistance here gets taken out, you form this perfect base here, and this becomes viable. It is at this point of time that you have a massive price void because you're buying into all-time highs. What you want to be doing is when you're looking at any form of a stock to buy, you want to always buy when you have an entire void that your price can surge into. You don't have any price resistance, averages are all lining up, and the stock will naturally trend upwards. It'll take a very, very significant move for it to actually negate that and come back into the range. So if I were to go back into one of the previous slides, in fact, the foundation slide, you buy, you basically, you drive ahead, you overtake cars, you move faster, you hit your pedal, your foot on the pedal only when the road ahead is clear. So this is that picture of power, the state, and every buy entry should come in as much of a picture of power that resembles close to this. So in summary, price above the 200 DMA, 20 DMA above the 200 DMA. The price surge is at least 30%, and this is possibly the most important thing. Void. The price void is what we look to capitalize on because that's when our expected move can actually be outsized. It's very difficult for price to actually go through prior resistances and then go ahead and make a new high in one clean move. Of course, you can keep getting a new high, but say if you've got prior resistances like this, and so you get a pattern, and even if you do buy, you would expect some sort of faults at these prior resistances. So it's much better buying, say, buying a base which is uptrending into all-time highs, this makes for a much better buy opportunity than say this, wherein the market has cooled off a little bit, but you're probably making a measured move back to a previous high. As always, if you want more information about our plans, you want to check through our strategy guides, you could either subscribe to a gold or the pro plan. Both of them have their benefits depending on what you're seeking, but we of course recommend taking the one which is fully loaded, that is the pro plan. Do note that you will get free trials of both. So if you don't like what you're getting, you always have that money back guarantee. Thanks for watching this video and stay tuned to our channel. You get a lot more content like this. Happy investing.